Imagine this. You've got $750 in your pocket. Maybe it's a tax refund, a bonus, or you've won a bet against your friend who swore pineapple does belong on pizza. It doesn't, by the way. Now the question is, what do you do with it? Stick it under your mattress? Splurge on a shopping spree? No way. We're going to show you how to be financially savvy and make that money grow. Let's get that cash snowball rolling. Hey there, savvy savers. Welcome back to Fun Financial Insights, where we make money talk entertaining and your wallet happy. Today, we're diving into a challenge that's hotter than the latest TikTok trend, turning $750 into a snowball of wealth. So buckle up, because we're about to make it rain with tips, tricks, and real-life data that'll have you rolling in dough. So why start with $750, you ask? Well, it's the Goldilocks of starting amounts, not too little, not too much, just right. It's enough to get serious with investing, but not so much that you're eating ramen for a month if things go south. Also, $750 is substantial enough to open an investment account or jump into a low-cost index fund. We're going to cultivate our $750 seed into a towering tree of treasure. And how do we do that? With the most potent fertilizer known to the wallet: compound interest. Now, I know, compound interest might sound like something you'd rather leave to the math nerds, but trust me, it's the coolest party trick for your money. Imagine you're at a party, and for every person you meet, you tell two friends, and they tell two friends, and so on. Before you know it, you're the most popular person at the shindig. That's compound interest in the social scene. And now it's time to choose the right investment vehicle for your $750, because what's a party without venues, right? Think of choosing the right investment vehicle as picking the right party to crash. You've got stocks, the rooftop bash with a view of the high returns, but a chance of rain. Bonds, the cozy dinner party, less razzle-dazzle, but a guaranteed good meal. Real estate, the block party that could become the next big thing. And let's not forget crypto, the underground rave where everything and anything can happen. Now, each investment vehicle comes with its own riskometer reading. Stocks can swing from mildly manic to euphorically erratic. Bonds usually chill at steady eddy. Real estate can range from growth gala to money pit. And crypto? That's off the charts at volatility fest. Now, choosing any of these may sound like a difficult thing to do, but guess what? You can be at multiple parties at once, and that's where diversification comes in. Diversification is like having each part of you at a different place. A little bit of everything keeps the mood right and the risk low. You can divide your $750 into parts and have each of them invested in different investment vehicles so that your risk is reduced and you can get the party started in diversified portfolio, grooving to the beat of different markets. Now, before we continue on, I just want to remind you to take a moment and hit that subscribe button so that you don't miss out on any of the future videos. And if you're enjoying this episode, please give a thumbs up. Now let's dive deeper into the world of investing and see how your $750 can grow over time with different investment options. Now, number one is the stock market. We're diving into the stock market's deep end with just $750 in our pockets, but fear not. With a sprinkle of wisdom and a dash of daring, we'll turn that modest sum into a wealth waterfall. Let's break it down, shall we? The stock market is like a bustling bazaar with companies from around the globe pitching their tents and selling shares of their dreams. When you buy a stock, you're buying a piece of that dream, a slice of that company's future. And if that company flourishes, so does your investment. Now let's talk numbers. Did you know that the S&P 500 has returned an average of about 7% per year over the past century? That's right. This means if you had invested $750 in an S&P 500 index fund, you'd have seen it grow year after year through thick and thin. And who can forget the legends of Wall Street? Take Warren Buffett. He started with a few $1,000s and grew it into billions by picking stocks with meticulous care and holding on to them for the long haul. It's the tortoise approach. Slow and steady wins the race. Now, picking the right stock is like choosing the ripest fruit from the tree. You want companies that are solid, with a track record of growth, and maybe even pay dividends, those sweet, sweet fruits of your investment labor. Think about companies that you believe in, products you use, and industries you understand. That's your investment garden. And diversification? Yes, it applies while you are picking the stocks as well. That's your financial sunscreen. It protects you from getting burned by any single stock or sector. So spread that $750 across different industries, maybe a tech stock here, a healthcare stock there, and perhaps a sprinkle of consumer goods for good measure. Now let's look at bonds. Can they help? Bonds are like the trusty old friend of the investment world. They're loans that you give to companies or governments, and in return, they pay you back with interest. It's like lending money to a friend who pays you back with a little extra for your kindness. Historically, long-term government bonds have returned about 2 to 3% per year. Not too shabby, right? But corporate bonds can be even zestier, offering returns of 3 to 5% annually, depending on their credit rating. And if you're feeling adventurous, high-yield bonds can offer returns upwards of 6% or more. But remember, with higher returns comes higher risks. Think of it as spicy food. The spicy food of investing, some love the heat, while others might prefer to stick to milder flavors. Bill Gross is someone who has used bonds as a vehicle to build a fortune leveraging bonds. He is in fact called the bond king. He made a fortune by understanding the ebb and flow of interest rates and bond prices. He knew when to hold them, when to fold them, and when to walk away. And here's a pro tip. Look for bonds with compounding interest. Some bonds compound interest monthly, quarterly, or annually. The more frequent the compounding, the faster your snowball grows. And number 3 is ETFs and real estate. ETFs are like the Swiss Army knives of the investment world. They're funds that hold a basket of assets like stocks, bonds, or commodities, and they trade on the stock exchange just like your favorite company shares. Now, why are ETFs so cool? Diversification. Yes. It comes up again here as well. Instead of betting all your chips on one stock, ETFs automatically, by nature, spread your investment across many, reducing your risk. And here's the kicker. You don't need to be a Wall Street whiz to pick the right ETF. There are ETFs for everything. Tech lovers, there's an ETF for that. Clean energy enthusiasts? Yep. An ETF for that too. Now, if ETFs are the bread, real estate is the butter of our wealth building sandwich. Let's spread that knowledge. Get it? Real estate investing might sound like a game for tycoons and TV personalities, but guess what? It's also for regular Joes and Janes looking to get a piece of the property pie. You've got options. There's the classic route of buying a property to rent or flip, but there's also a more hands-off approach. REITs, or real estate investment trusts. REITs let you invest in real estate without owning practical property. They're companies that own income-generating real estate, and you can buy shares just like stocks. And here's the best part. REITs often also pay out juicy dividends. It's like getting a slice of the rent. And now let's talk about another investment vehicle, yourself. Yes, you are also an investment vehicle. One investment you can never go wrong with is personal development. Investing in yourself is like planting seeds in a garden of financial prosperity. And what better way to cultivate your mind than through books? But wait, there's more. Personal development isn't just about books. It's also about honing your skills and expanding your horizons, whether it's learning a new language, mastering a musical instrument, or even taking up knitting. Every skill you acquire is like adding another arrow to your financial quiver. Investing in yourself pays off literally. It's said that boosting your professional value by just 3% can lead to a significant increase in your income. So imagine what mastering new skills could do for your business's revenue. We're talking a potential 10 to 20% annual increase. But wait, there's even more. If you were to invest 50% of your profits back into the business at the same growth rate, or any of the investment vehicles we discussed before, you'll see the magic of compound growth. Your wealth isn't just growing, it's snowballing. So there you have it, folks. Turning $750 into a wealth snowball is not just a dream, it's a journey. And it starts with you, your ideas, and the willingness to invest in your growth and the right investment vehicles. Remember, the biggest investment you can make is in yourself. If you're ready to start rolling in dough, hit the like button, subscribe for more financial wisdom, and leave a comment letting me know which piece of advice you're going to take action on today. Until next time, keep learning, keep earning, and let's make that money move.